Hi there, welcome to today's webinar. It's great to see there are so many people coming online. I'm sure there'll be many more in the next few minutes, and we're going to get cracking though straight into the content. So today's webinar is about how to perform forensic analysis on any stock in just 10 minutes. That's the title anyway, and it's quite a bold claim, but I think if you actually watch this webinar, you will find that that is exactly what we are going to do. And that's the value you're going to get if you end up internalizing a lot of these ideas and gain access to the kinds of tools and data that I will be sharing with you. Now, my name is Ed Page-Croft. I'm a chartered financial analyst. I'm the founder and CEO of Stockopedia.com. I started my career at Goldman Sachs in private clients before leaving and running a family fund, and eventually wound up trying to improve the tools online for investors, including myself. And Stockopedia.com started as something of a hobby project and then grew a bit out of control and is now home to around 15,000 private investors who use it for their everyday stock market analysis needs. And this really is a passion project. It's a passion project for me and for my team. And everything that we do is designed to try and improve private investor outcomes. And it all started from me coming out of the global financial crisis, which was a terrible bear market, not like this recent one we're in, we'll talk about in a minute. But that one actually led to a complete reevaluation of my own investing process, because I realized I got into all the wrong stocks by following tips and forums and so on. And I know we're in a nasty reversal from the pandemic bull market, and from all the questions that many of you thankfully have answered in the questions we sent out before this, the webinar and the survey. I know that many have actually been found themselves caught up in those sorts of situations in this most recent bull market. So I want to talk a little bit about that and about how everything we've put together at Stockopedia.com really came from precisely this moment, but 10 years ago. And I tried to lay the foundations for a business which could provide data-driven foundations to provide disciplined investment processes for private investors. So that's what we're going to be doing and sharing today. Is this for you? I don't want to waste anybody's time. So if this isn't for you, you do feel free to just leave now. But if you're a stock market investor and you're a seasoned or improving stock market investor, this really is for you. So for more seasoned investors, if you're looking to, you probably have got your strategy already sorted out, you know what you're looking for, but maybe your stock market research process takes you a lot of time. Well, what you'll learn in this webinar will save you a lot of time and effort in that research process. And if you're an improving investor or a novice investor, but you've been caught up in, for example, maybe tips or ideas from other sources, and you're finding your investment process a bit woolly, well, you will learn a much more disciplined and proven process for, well, I call it sanity checking stock tips, which actually was a phrase which was how one of our subscribers actually described what we do. And I think it's such a good encapsulation of a lot of the value that we offer through our rankings, through and a lot of the things that I'm going to show you today. So before we get started, quick disclaimer: nothing in this is investment advice. Yes, it's going to be educational, and a lot of the things we'll talk about are based on historical market data. And while the future tends to rhyme with the past, what's the great phrase? Now it's going to slip my mind, but you get my gist. The future isn't like the past, but it can rhyme. And the history of financial markets is a very, very good guide for what happens again and again. So remember, stocks go up and down. You can lose money in shares. And if you need a financial advisor, please do get one. But anyway, let's talk a little bit about the market. I'm sure many people are hurting, and share portfolios have been falling a lot, and not mine as well. And it's been a really brutal time in the market for many people. The market's got very overextended, and we're always going to reverse. And of course, when, as Buffett said once, it's only when the tide goes out you find who's been swimming naked. And we've seen lots and lots of problems especially in the debt markets. And that is probably going to take some time to unwind. But of course, as Warren Buffett also said, the best chance to deploy capital is when things are going down. So, we are seeing a significant regime change in markets. There's an inflationary environment we're not used to, and interest rates have been rising quicker than at any time, and certainly in my lifetime. And that changes what kind of stocks do well. And we've really seen a big rotation out of growth stocks, out of speculative kind of jam tomorrow stocks, and into good old-fashioned value stocks. And me, I'm in my I've been in and around markets quite a long time, and I remember after the dot-com bubble a very similar thing happened, and you saw a big rotation out of growth and into value, and those trends tend to persist for quite a long time. But the key thing is, in bear markets you can actually create that generational wealth, because you can actually pick up assets from forced sellers, and there's a lot of forced institutional sellers. Now, I'm not saying the market's bottomed, I'm not going to try and time the market or anything, but it's worth bearing in mind and having that confidence that if you can find things that are very, very good value, you can actually create very good wealth. And I have a really good story about that. There's a story of a pig farmer, and this is a wonderful tale from Forbes in 1978. I wasn't reading it at the time, I was only 3 years old, but Mr. Womack was there was a stockbroker, actually, not Mr. Womack, but there was a stockbroker who had a client who kept messing up in the market. And he said, and the stockbroker thought, well, can I introduce you to someone? And he introduced him to this guy, Mr. Womack, who was a pig farmer. And this guy had never lost money in stocks in 40 years. And he had a very, very, very simple strategy. Basically, he treated it like buying a truckload of pigs. And basically, whenever there was a bear market, and often he didn't really track the stock market, when there was a bear market, he'd read the news and he'd see there were really bleak headlines. Well, he knew if he was dealing with pigs, that was a great time to go and buy. So he'd go and buy, went to Wall Street, you couldn't do it online back then, and he bought 30 cheap, profitable stocks, actually drove in to his stockbroker and did it. And then a few years later, when all the news headlines were wonderful, he'd sold everything. And that's just another story. And this guy had absolutely fantastic returns and never lost money in a sale on stocks in 40 years. So it's a really good reminder of some of the lessons of bear markets and preparing oneself for what's to come. Anyways, onwards. This is 1 hour to be invested in yourself. Education is the greatest thing we can do. If we all spent 1 hour learning a day, we would achieve really great things. Or so I tell myself. And today we're going to talk a little bit about how to save time and improve your results using what really are what I call stock reports, or summary, concise views of the essential financial statistics on shares. I'll be showing how effective they are and why they're such a powerful means for improving your investing. Now, there are 7 key areas to understand for every stock you own that I'll share in a moment, and I'm going to really look at in a bit of depth. I'm going to summarize quickly and then go and look at in a bit of depth. And then we're going to analyze a few stocks, some growth stocks, income stocks, and common traps. And then I'll do some Q&A and requests. And great, let's crack on. So firstly, before I do this, I just want to talk about the power of simplicity. Simplicity in your investing is so, so important. And I've always tried to, I was always attracted to a certain form of summary view on a share, because I was always a scientist at university and afterwards. And I always believed that data-driven investing was, all my books are about this as well, about really trying to find the shares that have the traits of long-term stock market winners from history. And the only way you can really do that is through statistics. I mean, Ben Graham said once that the market is like a voting machine. The story wins in the short term, but in the long run, it's the weighing machine that wins out. So stories are how often get us into stocks, but it's the statistics which will end up proving what's winners or not in the long term. So this all came from a lineage of one-page, actually print formats, which is a bit outdated now, but Value Line in America is a great product. Warren Buffett uses this, and it's still published today, to flick through pages to find the shares. As he said, he starts at the A's and he moves through to the Z's, and he looks at one by one to find really interesting, cash-generative, high-quality shares. And in the UK, the great Jim Slater founded a company called Company Refs, which stood for Really Essential Financial Statistics, which had a similar kind of point of view. Now, for those of you who might know, Slater Investments is run by his son, which is a very successful fund management company. And unfortunately, Company Refs went into administration a number of years ago, having changed hands a few times. We bought it in tandem with Slater Investments and to try and resuscitate it. So a lot of the themes that go into Stockopedia come from this really good lineage of great investment products. And why does format really matter? Well, it's a forcing function. The wonderful thing about the one-page view is that the design forces essentialism and a kind of clarity of purpose. You have to throw some things out and really figure out what goes on the page. And it also ensures a very high signal-to-noise ratio. When you're out there just hearing stories about stocks and scanning, trying to sort of find the news, there's so much noise out there. But on one-page views, you get absolutely essential financial statistics, and there's real quality over quantity. And this actually does translate into more confidence in your decisions once you learn to read the data, which I'll be explaining shortly, and better decision making as a result, and also masses of time saved in your research process. You often don't need to do too much to have a really, really good result in the stock market. So into the 21st century, we took this print ethic, we brought it all online in these really fantastic one-page views that give you all the essential statistics on stocks, and allows you really to do this forensic analysis in seconds I'll be sort of sharing with you shortly. So let's crack on and have a look at the 7 key areas on these reports to really try and hold out that promise of doing forensic analysis in just 10 minutes. So first up, this is Occidental Petroleum, which is a stock which Warren Buffett has been buying, and I'll be showing you that later. And it's a US stock. It's a big market, large cap in America. And I just want to highlight a few things that I like to look at straight away. And this is what we're going to be going into more depth on. Firstly, the quality, value, and momentum. I'll be teaching you how to understand the 3 factors that really drive stock market returns. These are what we call the stock ranks, and I'll be explaining them and showing you that really, if you look at these, they're the very first port of call on every share, keeps you out of so much trouble in the stock market. The second thing is the classifications. This is we have 4 types of classification: the sector, the risk rating, the size group, and the style. And it creates this wonderful phrase which will help you distinguish your adventurous large cap super stocks from your speculative small cap sucker stocks and everything in between. This really, knowing the category of a stock you're dealing with, is a big accelerator to really understanding a share. Next up, we have lots of these things I call the traffic lights, but these allow you very, very quick peer comparison to let you compare essential statistics like the P ratio, the yield, the return on capital against the industry and the market as a whole. Beyond that, red flags. So there are a bunch of, I like reading academic research because I'm a bit weird like that, but there are all these professors that have created these wonderful algorithms which we've then designed into an interface to help you avoid sort of disaster from bankruptcy and earnings manipulation risk, and also to monitor the health trends. So we'll talk a bit about those. This section shows you what strategies a stock is qualifying for. So it instantly lets you know which set of screening rules a stock might pass for, which helps you kind of understand the types of investors who might be buying it. And if it's missing, I always know it's probably off a lot of people's radars. In the financial summary, this is just a little snapshot. There's a lot more to it, but you can kind of use the history of a stock to predict its future, really reading the runes of the history to try and see what the corporate habits are, because they tend to persist, and there's some real intel you can get from that. Next up, the shareholder activity or smart money sentiment. We've got a couple of indicators, one lower down on the page too, which helps you kind of predict the direction of travel by analyzing professional investor behavior, like real buys and sells, as well as real analyst sentiment. And those are the 7 key things that we'll be looking at. And once you learn how to understand these and what to look for, they really can change your investment process. They've completely changed mine. And I used to use this, as I said, of different products before we built our own. And this really is a life's work going into this. So how can they transform your process and results? Well, I've been a real student of the domain, especially after my problems in the financial crisis and in that last bear market, which really kind of hurt me. And I poured over all kinds of academic research and found that there were all these studies of private investor accounts from real brokerages, which showed that it wasn't just me, it was like everybody was doing the same mistakes. And if you look at the studies of American brokerage accounts, UK, Taiwanese, Canadian, Swedish. There's so many studies out there, and it shows this kind of general tendency of individual investors to underperform. And it's a really, it all comes down to the same kind of key themes, that picking the wrong stocks, under diversifying, and so on and so forth. Now, because we all kind of make the mistakes in the same way, you've got to, if you want to get better performance in the crowd, you've got to do things differently. This is Sir John Templeton, who famously in every bear market used to go out and buy, or there was one bear market, he went and bought every single stock he could that was priced under $1, and he made an absolute fortune that way, and he ended up creating Templeton funds and everything else. So he did do things differently. And the one thing I'd implore investors to do is do things differently to what they see other individual investors doing, which is just investing based on narrative. Now, I've got a few stories from our subscribers to sort of explain this, and I know some of these personally I've met at conferences and so forth, but and there's a before and after story here that really sort of explains the way this can change a process. And you see, investors often say before they took this data-driven approach, they have a very unstructured approach to picking their investments. They might say it was haphazard or a woolly approach. And they often pick shares from financial publications, from tips, magazines, press, and they often weren't confident about their investing. And then if you take these principles to heart, you end up having more disciplined confidence in results. So you see people making much more decisions, more grounded in data, improved results, more confidence, more screening, and really having a positive impact. So I will share these slides with you all after the webinar. We'll send them out to you. And but genuinely, it can be a really transformational thing in your results. So I'm going to go deeper into these actual 7 key areas now. And this will take a little while to kind of run through. We've already had 15 mins or so, and but I'm going to explain to you these 3 factors. Firstly, that drive stock market returns: quality, value, momentum. Up in the top right corner of these stock reports, and we'll be giving you access to the site so you can check this out. You'll see that there is this little widget here, which gives a score between 0 and 100 across quality, value, momentum. We call these the stock ranks, and they're a simple measure to identify good, cheap, and strong stocks. And I'm going to go through each one of these in turn, but they're all ranked from 0 to 100, where 100 is best, and they're color-coded so for easy understanding. Firstly, quality. So, if you're in conversation with somebody, they'll probably say, oh God, there's this great stock. They've got this mine somewhere, or they're creating this technology. Oh God, the people running it are brilliant, and that's what people think is a good stock, right? And it's not. It's not a good stock. Warren Buffett would go, you have to buy cash generative, long-term profitable shares that are stable, and that is the real fundamental, definition of quality. So we firstly assess whether a company is strong and stable by looking at long-term profitability, return on capital, gross profitability. We look at cash generation from the free cash flow, and we look at the stability of operating margins and growth as well. And that is kind of what we call our franchise factor, and that's the first thing that goes into the quality rank. Beyond that, we also look at whether the financials have got better from last year to this year using something called the Piotrowski F-score. We'll talk a bit more about Joseph Piotrowski when we get to the red flag sector, but that's a key factor that goes into our quality rank. And we also look using other red flags to see whether it's safe from catastrophic risk, so the risk of bankruptcy and earnings manipulation. And all these factors go into our quality rank, which gives you an immediate litmus test of whether something is a good stock or not, a good stock or a junk stock. Good stocks tend to beat junk stocks. I've got data on that I can show later if anyone's interested. Next up, the value rank, a simple measure to find cheap stocks. So cheapness is, a lot of people don't like buying cheap things because they're often low quality, and there are these trade-offs. But actually what you find is that people, because they're disgust, they throw away cheap stocks and they make them too cheap. And that leads to them outperforming over time. And they bid expensive stocks up too high and they get crushed. So in this bear market, the number one thing has been that expensive stocks have been absolutely super hurt. So in an interest rate environment, where a higher interest rate environment, you find that you get this valuation compression, and really expensive shares get their multiples, their price earnings multiple crushed. So The value rank is a really simple way to understand the cheapness of a stock. And 100 is cheapest, 0 is most expensive. And we look at whether a company is cheap against what it earns. That's a kind of my catch-all bucket for price to earnings, price to cash flow, price to sales. These are all kind of measures of sort of income and sales income and cash income. Is it cheap relative to what it owns, which we compare the share price against the company's book value or its equity value? And so that, even companies without earnings, or even without sales, they often have still have a price to book ratio. And that allows us to really create a measure which covers a lot of bases. And also, is it cheap relative to what it pays out in dividends? So as an investor, if you ever had a dividend check, very nice thing to have. Thank you very much, company. Those earnings are shared with investors to a certain extent through dividends. And cheap shares have a tendency to beat expensive shares. Thirdly, the momentum rank. And this is a concept which is quite alien to a lot of investors, but is probably the most powerful factor of all three of these factors in predicting the future returns. And it's a counterintuitive factor. Essentially, if a share price is strong relative to the market, it tends to continue being strong. So we rank stocks breaking through to their new 52-week highs, trading above their 200-day moving averages and showing strong strength. We also look at whether the earnings and sentiment trends are strong. And by that I mean, are analysts increasing their forecasts for a stock? Are analysts improving their recommendations? And is the company surprising the market to the upside relative to forecasts? These come together into our momentum rank, again ranked from 0 to 100. So you get a simple measure to find strong or improving stocks. And all three of them come together in an equal weighted composite, re-ranked from 0 to 100 as a percentage in what we call the stock rank. So this system is a very, very powerful system, and I'll show you the results of that shortly. But once again, think 0 is worse, and it's RAG rated, red, amber, green rated, so that junk, expensive, weak shares are lowest ranked, and good, cheap, strong stocks are green and top ranked. And anything in the middle is kind of grey. So 100 is best and 0 is worst. One other thing is that you can see the history of the stock rank down here. So if I zoom in there, this tracks the rank through time. And this is a really cool little thing. And it's got a kind of a green bullish zone and a red bearish zone. And, often stocks ranks will jump up and down through this. This actually tracks the composite of all three, quality, value, and momentum together. But it's a very, very useful bit of intel on any share. And I'll talk a bit more about that in a moment. In terms of the performance history of the ranks, they have done exceptionally well, and even in spite of this reversal that we've been going through. And we've tracked the performance since we started publishing them in many regions. And this is the UK tracking. And as you can see, 90 to 100 ranked shares have significantly outperformed the rest of the market. So this is what we call a decile chart. And this green line is the 90 to 100 set. The bottom is the 0 to 10 ranked set, which has significantly underperformed. And we track, and there's FTSE All Share in the middle, which is the benchmark. And if we make this sort of simpler to understand in a bar chart, you can see on the right here, 90 to 100 ranked shares have done about 14% annualized over this period, and 0 to 10 have done much worse. And this is very corroborated with subscriber results and so on and so forth. And you get this kind of extraordinary, almost uniform return difference between each of these classifications of shares. And it's a very, very powerful thing. This really is how the stock market works. And if you aligned your picks with higher factor exposure shares, good quality, good value, good momentum shares on a more systematic or disciplined basis, you can get better returns in the market. Sadly, a lot of the narrative-driven shares are often much lower ranked. And it goes again into the kind of average, what I call the win rate or hit rate of picking winners in each cohort. So again, on this right-hand side, you can see in blue the percent of winners on any average annual any average annual period since we started this system, and almost 2 to 1 winners to losers in a typical year. Whereas at the other extreme, it's more than 2 to 1 losers to winners. So it's kind of a game of odds. You're trying to select shares with a higher probability of outperformance. Now, one of the questions came in, and I thought I'd add this slide before I move on to step 2. When to sell? And I thought I'd answer this just through the perspective of the stock ranks. So there's some great research by a guy called Christoph Reschenhofer called Combining Factors. It was a very similar ranking system to ours, and it really showed that you effectively, if you use a buy rank for purchase and a sell rank for sale, he found that the optimal set was a kind of a 90 ranked purchase and then a 70 or so ranked sale. And really, that is a kind of example that I've used a lot in my own investing, and many of our subscribers have said they've had best results with. And this is an example of Reach PLC, which is kind of the old Trinity Mirror in the UK, which owns a lot of old national newspapers. And this one had an extraordinary run in the pandemic, and it bounced up above a 90 rank and then moved through a 100p and then more than quadrupled. And at that point, it dropped down through 70p. And so it was a very, very good sell rule for me. This is probably one of my best timed personal investments, getting out at 395. But our investment club as well purchased this and bought it as well as I did in my PA. So it's an example of how actually a sell rule can be very effective. And post that peak, it declined enormously. So it doesn't always work. Of course, it doesn't always work. But in certain cases, there's some really good case studies like this. Secondly, we're going to look at classification. So I'm going to take a sip of water. This is to know the category of stock you're dealing with in a very simple phrase. So up here in the top left of a stock report, you get these classifications. And there are 4 different classifications. The sector, the risk rating, the size group, and the style. And these are very, very powerful. I'm going to zoom in one by one. Firstly, sector. Now, I'm sure we all know the difference between an oil stock and a biotech stock. But we have a 10-level classification based on every stock's economic sector. We also have a sub-level, which is industry groups. But I want to talk you through this because most people don't look at classifications, and they end up buying mostly shares in the same sector, and which ends up being a single sector bet. So classifications like this are so important for your portfolio diversification and construction. The one lesson I've learned is don't believe your own narrative too strongly, because you may well be wrong, and invariably we are wrong more than we're right. And hedging your bets by using diversification across sectors is very important. So we have 10 different sectors. There's 3 in cyclicals: basic materials, which is mining, chemicals, that kind of thing; consumer cyclicals, which includes big ticket consumer items like cars or fridges and that kind of thing; financials, investment banks, retail banks, anything like that; defensives, which did so well in the pandemic; healthcare stocks, biotech, pharmaceuticals, which all were some of the barnstorming winners in the pandemic; consumer defensive stocks. By that we mean food, we mean anything you need, like cleaning products, the things you can't go without that everybody needs even in a terrible bear market, and they have great resilience; and utilities, you've got to have lights on, got to have lights. And these kind of are very defensive sectors which do well in most environments. Doesn't mean the stocks can't move down, but you tend to see that the market, people reallocate towards defensive sectors in certain environments. And there are 4 other more sort of in-between sensitive sectors. Industrials, you've got everything from hard machinery to, softer industrials. Energy, which includes renewables, uranium, oil and gas. Telecoms, phones everywhere; and technology, I'm using lots now. So those are the kind of 10 key major buckets, and making sure you have diversification across either the super sectors, cyclicals, defensives and sensitives, or across at least several of the sectors themselves. Moving on, the risk rating. Now this is something that I think catches out the vast majority of private investors. We all love to invest in highly speculative stocks for whatever reason. We are like moths to a flame, and because they have the best stories, but they are the stocks that collapse the hardest in bearish market periods. We have this 5-level classification, which is based on every stock's annual volatility, and it's classified from conservative, which is the lowest risk, through to highly speculative as the highest risk. In the middle is adventurous. So this one, Occidental Petroleum, is adventurous, which actually has a volatility band of about 35 to 45%. Highly speculative stocks can have volatility of 75% to 150% plus. And this is, a really key thing to try and understand. We found very negative returns to highly speculative stocks, and except in the pandemic when they did really well because of all the free money that was being showered around. But that was the only environment where this really inverted. And we found generally that this hasn't been updated for a while, but highly speculative stocks have done quite poorly, and in bearish markets especially. So you find that the risk ratings, it's a kind of a tortoise and a hare story, where the hare speeds off and does really well in risk on markets, but the tortoise, the kind of the lower volatility shares, end up winning out over the long term. And moving on, the size group, many people love small caps, and small caps are one of the really great parts of the market to invest in, but only if you buy the quality stocks. You must buy quality small caps. It's the junk small caps which crush investor returns. So anyway, we've got the size groups here: large caps, mid caps, small caps, micro caps. There are large caps is kind of equivalent to FTSE 100 above 2.5 billion, and in Australia it would be more like the ASX 50 in size. Mid caps are FTSE 250. Really, you're kind of talking about 350 million to 2.5 billion, and small caps under 350 million, and micro caps under 50 million market cap. Personally, I tend to avoid a lot of micro caps, even though the returns can be very, very good. But they have they can be quite illiquid, and liquidity becomes a real problem in bear markets. And so if you found yourself in highly speculative small and micro caps that have been very tipped but that are low quality, you will find that that is a painful experience, and I've been through it myself. And I would say that one of the first things to do is go and check points 1 and 2 and scan your stocks for these figures, because it's so enlightening and it really does map to the long-term returns that investors will get. One thing on size metrics, up at the top, we've also included the market cap, which most people know. In this case, the market cap is 60 billion, but the market cap only shows the value of the equity. In other words, the number of shares times the share price. And what people don't realize is it doesn't include the debt. And enterprise value is a kind of term that somebody will quickly close their eyes at because it seems like really finance geeky, and it is finance geeky, but ultimately it's really simple to understand. You add the net debt, or everything a company's borrowed, to the market cap, and you get the enterprise value, so net of cash on the balance sheet too. So net debt. You can see here for this company, it's got 26 billion of debt on top of the market cap. So you instantly know that there's almost half of the market cap is in debt. So it gives you a quick sort of understanding of its gearing or its potential interest rate exposure, etc. So important to know. Let's move on. The next classification is the stock rank style. This is a 9-level hierarchy, and it's based upon the stock ranks. I'll explain all of these in turn, but we've got 4 winning styles which are color-coded green. And these are super stock, high flyer, turnaround, and contrarian. And I will show you the fingerprint of their stock ranks and how they come about in a moment. There is about a third of the market which is unclassified. So we got about a third of the market in winning styles, a third of the market unclassified, and a third of the market classified in losing styles. Value trap, momentum trap, falling star, and sucker stock. Now these phrases, super stock and sucker stock, actually come from Robert Haugen, a great professor, who, well, he actually called it super stock and stupid stock, but we've rephrased that as sucker stock because really often you find that they're driven by stories and narratives, and they tend to sort of suck us in. And actually, I was a poker player, and I there's a lot of chat in poker circles about if you sit down at a table and don't know who the sucker is within a few minutes, then it's probably you. So it's really it comes from that sort of line of thinking. And really, the winning styles have historically outperformed, and the losing styles have historically underperformed. In general, on average, not all the time. And but that is really important to know. Now, the way that we've composed these styles is by taking, and if you zoom in here on this super stock classification, QVM, quality, value, momentum. The 4 winning styles, a stock is strong in at least 2 of the 3 ranks. Super stock strong in all 3. And then these 3 other winning styles are strong in at least 2 of the 3 ranks. So a turnaround tends to be quite low quality, but it's cheap and it's strong. A high flyer has very good profitability, and it tends to be have high momentum, but because of that, it's quite expensive. But that's your kind of your growth stock classic archetype. Contrarian stocks are high quality, very cheap, but weak momentum. So you kind of buy on the dip kind of thing. And the losing styles, well, the sucker stock has poor quality, really expensive, and bad momentum. So, which is a really, really terrible place to be when you're investing. And momentum trap only has momentum going for it. Value traps only have value going for them. So in other words, they're only cheap. They've got nothing else going for them. And falling star, some of the best stocks in the market, when they've been high flyers, if the momentum caps out and brokers start cutting the numbers, they become falling stars. And it's one of the worst places to be, at least for a period of time, at least for the next year in your investments. So worth bearing in mind. And next up, this is just a chart, which I know everyone's under time pressure, but generally you've got the winning styles over here on the right and the losing styles on the left. And this is, again, that hit rate idea that you get a higher win rate in winning styles than you do in losing styles. The third thing I want to zoom in on is the peer comparison. And this allows you to, for any financial ratio, or at least the essential financial ratios, to compare the absolute number against the peer group of the stock, the industry and market peer group. So if we zoom in, we call them traffic lights. But essentially, if I show you here on the left, so imagine you've got a P ratio of 9, and that you don't really know what that means. Well, you can compare it against the market and against the industry. So against the market as a whole over here, you can see that it's got a meter here that is kind of green and fairly full, and that shows that it's cheap against the rest of the market. If it was a bit less, it would be amber, and so a P of 15 might be average or worse. And if it was really expensive, a P of 48 or so, and that's really, really, very expensive. And you've got to make sure it's really quality stock to keep hanging on to it. And that is a very, very powerful system because it really helps you very quickly scan key fundamental ratios and understand them against the rest of the market. And you really can't do that if you're just given the numbers like on most normal websites. So important to know. The other thing is if you hover over them, you get a nice pop-up which shows you the ranking set that rank is done against. And one important thing to just bear in mind here, these are forecasts. We use rolling 1-year forecasts. It's quite an important point because you can get really led astray by comparing companies that have different year-end dates. And I want to run through a quick example of this just to kind of show you what I mean. If you imagine a company has a current date, it's not September, but call it September, and let's say it has a share price of 300p, and it has a year-end date at the end of December. And so if its forecast earnings were 20p, it would be on a P of 15 on a forecast basis. Well, if you took another company, let's say company 2, that reports in just under a year and has the same forecast earnings, you'd also think that was on a forecast P of 15 times. But they're not. They're not actually valued the same. If you imagine and you projected the earnings of the first company forwards to a rolling 1-year point, which was equivalent to that other company too, and you weighted a quarter of this year's forecast earnings and 3/4 of next year's, you would find that the actual rolling earnings forecast was about 27.5p, which might put it on a P of under 11. So you're not comparing like for like. And on most financial websites, you will not be comparing like for like because they are not standardizing these ratios. And I think it's really important because this is like, a significant discount to the other stock. And if you bought it, you might do much better. We also, on a historical basis, use trailing 12-month earnings, trailing 12-month periods as well, which I won't go into now, but again, sort of standardizes the historic ones too. On to point 4. Red flags. This is about the time-saving algorithms from finance professors that help you avoid disaster. They're a little bit lower down on the report, right here. And I'm going to zoom in on the health trend, the bankruptcy risk, and the earnings manipulation risk. So this is Joseph Piotrowski's F-score, which I really adore. It's a 9-point checklist. If you want to know what goes into it, you can actually click the blue link and you get actually a pop-up of all 9 checks. And it shows you those checks for that stock in question. But generally those checks measure last year against this year and look for improvement. So yes, it looks for profitability and cash flow, but also improvement in profitability from last year to this year, improvements in paying down debt, improving liquidity, ensuring it's funding itself, and that its operations are getting more efficient. So if this is high, 8 or 9, you know it's getting better. So often when you've got like a bad company, or looks like a bad company, a cheap company, but you see it's got a good health trend, that can be a really good leading indicator of improvement. Secondly, the bankruptcy risk. We've got debt ratios on the stock reports too, so you can look at gearing. But this is Edward Altman's Z-score, which is from the 70s, but it's still a powerful indicator. And it's, if you were to just look at the Z-score numbers, you wouldn't know what they mean. But we've put all of these into really easy to scan indicators which show you where on a scale where that score is. So it's got a safe zone, a cautious zone, and a distress zone. And more generally, the distress zone means that there's a higher probability of some form of financial risk in the next couple of years. So it'd be more likely that we'd need to have some fundraising or anything like that. The third one is the earnings manipulation risk, or what I like to call the cooking the books score. And this is from Mesod Benesh, who wrote a wonderful paper on this. And we've published this rather differently as a high and low flag. And this has spotted so many problem accounts where companies have massaged their earnings to make them look better than they are, and or even done it innocently. And because there can be a lot of reasons why these things can happen. I'm not saying that you necessarily have fraud, although there have been some out there where companies kind of, like I remember Globo was one, and where they just were out frauds. But and this indicator actually identified the Enron fraud, where experienced analysts failed, and it spotted a lot of kind of accounting anomalies at companies like Superdry and so on and so forth. So really good indicator to know, and it's especially for growth stocks. The fifth thing I want to go through is strategy qualification. I find this super, super useful on my shares. And on this one, you can zoom in. And this is a little box that shows you any screens that the stock has passed. And we have a library of 65 famous strategies, all pulled from famous books, famous academic papers. And we try to sort of roll up a set of screening rules to tag every stock with. And often you can see a share will qualify for quite a few of these. And there is also short screens as well, which can be indicated by a red tag too. And it looks at value, growth, income, momentum, etc., etc. And one of the things, like the benefits of this, is that I know that people out there do use these screens as professionals, and or professional investors use these types of screens in their day-to-day life. And so if you know a stock is qualifying for a screen, you know that those sorts of investors might be looking at that kind of share. And it really gives confidence that it might be a promising investment candidate. Next up, number 6, the financial history. I'm going to go into this a little bit because this is something that most people don't go into. And most people don't go into any of this stuff. So this is why it's so important. Now, this financial summary, yes, at the top, you're going to get the kind of the scan, the revenue, the profits, the EPS, the P ratio, the PEG, and so on. But I want to zoom in on some narrower parts of this and just highlight a few things that a lot of people don't look at. Profitability. If you are buying quality stocks, it does depend on your strategy, but quality stocks, check for high and stable profitability. Firstly, operating margin. Now, that is an industry-specific number, but operating margin you'd like to be as high as possible against to other companies, and higher margin stocks are generally preferable. We've got these 3 profitability metrics: return on assets, return on capital, and return on equity. Return on capital employed, it shows you the percentage profit made on every unit of capital, which includes equity and debt. And 20% or more can indicate a rare competitive advantage, the kind of companies that Warren Buffett likes to buy. And interestingly, this one Buffett is buying, and it has a 17.8% return on capital at the moment. Interestingly, you can see that all these numbers were hit. This is an oil stock, and in the pandemic, no one drove their cars. The whole oil industry kind of semi-collapsed for a year. And you can see it reflected in the numbers here. So this kind of always can tell you a tale of a share just by looking at the numbers. And return on equity, again, is another one. But it shows you the profitability just compared to every unit of equity in the company. And strong, consistent ROE is kind of most important for a shareholder, because a company will pay some of it out as dividends but retain the rest to reinvest in the company. So you can think like a very, very high number here shows that every pound reinvested in the company from its profits is reinvested at that percentage rate of return. So it's a kind of powerful compounding indicator. Next up, the cash flow section. Check if cash flow is flowing freely. Very important. The very best investments are cash cows. How do you identify them? And like I said, we do factor some of this stuff into the quality rank, but this gives you more detail. You should seek companies where the majority of earnings per share is converted into free cash flow per share, or even better than that. And I'll show you an example later, one that does it better than that. And free cash flow per share here is in this line here. And it's the difference between the operating cash flow minus the capital expenditures, because a company that has, like Occidental Petroleum, is investing in property, plant and equipment, and they have to do those capital investments, which is a sucker on free cash flow. But free cash flow, it's very important. It can pay for dividends. It's a lifeblood of a business. Pays down debt, pays dividends, buys back shares, makes capital investments. And remember, earnings can be manipulated, and they really often are. Cash flow is hard to fudge, and that's why things like the earnings manipulation risk actually factors some of these things in. The next thing I want to look at is the dividends. Now, not everybody invests for dividends. Many people invest for growth, but I know many of you will be dividend investors on this call. And we have this really simple scannable thing that shows you the dividend history. So you should always check for consistent and ideally growing dividend without evidence of cuts. So you can see here, this one did cut its dividends in the pandemic, was growing very consistently, and then bang, went down. And of course, once cut, it hasn't come back yet. I presume with the oil profits that they'll reinstate it at some point, but it's really been very, very low ever since. And the other thing to look at is the cover. Dividend cover is how much the dividend payout is covered by earnings. And, it's always a sign that a cut may be pending if the dividend cover kind of drops lower than 1. So I put the wrong thing on the slide. I should say less than 1 risks a cut, and which I'll repair before sending you the slides. But generally, you can see here that the dividend cover for Occidental Petroleum was very low up to the pandemic, and then it did cut its dividend. So that's something to beware of. Any other red flags, may also impede the ability to pay dividends. So bear those in mind too. Now, there's a hidden line down here under the balance sheet, which I want to focus on, called average shares. And for a private investor, this is such an important thing to look at. I can't express it enough. This is share dilution is the biggest thief of individual investor returns. And it happens in these story-driven stocks all the time. And I say this, I really need to make more of this, but increasing average shares suggests regular share issuance. If it goes up too much, then that means a company may not be self-funding. They're having to raise equity capital from investors. And once they start, they do it again and again, and they often further dilute your shareholding. It's much better to see decreasing average shares. It indicates a company may be buying back shares, which increases your shareholding. And this is a really good sign of financial strength. I'll show you probably 1 or 2 shares later who have been rapidly increasing the number of shares in issue. And the final thing I want to talk about is smart money sentiment. This really helps you kind of predict the direction of travel by analysing professional behaviour. There are a couple of points on a stock report. Firstly, up here at the top, the shareholder activity. This helps you review the buy and sell sentiment of real shareholders. This is real activity in the market. We have a database of ownership data and insider director dealings data for global stocks from 2 different sources. And the first thing is the institutions, so funds and fund managers. They're the biggest players in stock markets. And if you can see, like on this chart, like a little green flash here, it shows you that institutions have recently been accumulating stock. And red shows they've been recently selling. On the director buying, open market buying, has significant predictive value for future stock returns. Open market selling less so, because people often sell for whatever reason, buying houses and the like. But open market buying is very, very useful to know. And this is actually a special thing for Stockopedia, but it's community activity. This is a kind of a view on individual investor movements. And this shows the community have been quite heavily buying Occidental Petroleum recently, more than they have been selling in their portfolios. So a key thing to understand. One thing here, you can see that little flash there. Well, if you actually go and click the view on the right, it takes you through to actually a breakout page. We've got more pages than just a single page. You've got all the accounts and directors' deals and statements. But this shows you that Berkshire Hathaway has recently massively increased its stake by buying another 30 million shares. So that's Warren Buffett's firm going out and deploying more capital into oil and gas, which I think is pretty interesting. Now, the next point on this is another thing to scan. Okay, it's two things to scan on the smart money, but this is the analyst consensus. And this has a couple of components. Firstly, the actual analyst recommendation. Now, I'm going to troll this slightly because you need to beware of the consensus of analysts. The buy recommendation, this shows a meter from strong buy to strong sell. And the black arrow shows the current consensus of all analysts. The grey arrow shows the consensus 3 months ago. But beware strong buys. If you see that right up here on the right, we've done a study on this, and it shows that the strongest buys actually underperform stocks that are marked as sells. And while that was only a 3-year study a number of years ago, but it's quite indicative. But generally, shares in this kind of region are okay. But I don't tend to put much credence on it. I'm much more interested in the difference of the way the recommendation is going, which is more of a leading indicator. This chart here shows you the trend in consensus estimates, the trend in profit forecasts for each of these 2 years. So this is showing the year end for 2022 has trended up. The forecast from all the analysts covering it, 25 of them, has gone up and up and up over the last year. That's a really good sign. There's bags of research. There's one study I flag here from McKnight and Todd, which shows that European stocks that had the highest upward earning revisions outperformed the lowest by 16% a year. So looking for earnings increases is a powerful momentum factor, and it's really worth bringing it into your investment process. So the rule of thumb is to focus on purchasing shares where the trend is upwards, because trends tend to persist. So that is the key 7 kind of things to focus on. And just going to check on the time. Yeah, I've been going for almost 50 minutes now. I just want to share you some of the results because we survey our kind of subscribers regularly or investors regularly who use this stuff, and it really does have real impact. Every year we do this survey and we get the same sort of results. Since subscribing to Stockopedia, has your performance outperformed or underperformed the market? And you can see here that, I think it's about 65% of people say that they have outperformed or significantly outperformed the market, and matched 23%, with only about 3 or 4% saying they've significantly underperformed. Now, I would say that is a fantastic outcome for people who are using these kind of ideas into bringing more discipline into their investment results. And the other thing is that generally, and almost everybody says that they feel more confident in their understanding of the stock market since using these sorts of tools. So this is about bringing that data, the disciplined, data-driven approach into your investing. It just has such a big impact on your confidence. And stock market is so much about confidence. And almost nobody feels that they're less confident in the stock market using these kind of tools. So very important to know. Now, I was going to, I want to jump onto a bit of Q&A in a mo, but I thought it'd be probably worth just having a quick look at a few shares. So I'm just going to pull up, here's Occidental Petroleum, which we just looked at. But I thought it would be maybe better to look at like a stock like, let's say, Peloton, which is kind of at the other end of the spectrum at the moment. And if you are an investor who has one of these at home, which I do, absolutely fantastic product. I have to say it's a brilliant product. And I use it all the time. But you've seen through the pandemic, it had this absolutely barnstorming run, and then it sort of collapsed down. And interestingly enough, if you zoom up here on the right, the stock rank is only 14, and quality's low, the values, it's still expensive. That means it's still expensive, and the momentum is poor. And you can see here it's got, that's the first thing I look at. Second thing I look at is the classification, speculative large cap sucker stock. What can I say? It's got really not my classification. It's consumer cyclical. It's a heavy ticket item in a recession, and you can see here again, looking at market cap against enterprise value. Well, it's got some debt, certainly some net debt, not masses, but there's about 500, 600, 700 million of on top of the market cap. Scanning the traffic lights. Well, big red flag here. P ratio immediately says there's no earnings. Earnings growth not available. Dividend yield none. So you've got no kind of stats here at all. And even on a book value view, it's super, super expensive. It's almost the worst, most expensive in the leisure products market. Price to free cash flow, there's no cash flow. And price to sales, it's a bit better on a price to sales basis, which is probably the one sort of saving light here. Quality is really poor. And the next thing I'd look at is the professor flags, the red flags. The health trend is weak, which suggests deteriorating fundamentals. The bankruptcy risk is high. Not much evidence of earnings manipulation. But as we can see, that's quite a lot of things to look at. Is it qualifying for any strategies? Well, the only strategy it's qualifying is a short selling strategy, which is based on its bankruptcy risk. So, what can I say? Definitely no screens past there. The rank has been very low for a long time. And as you can see, it's been low and it's got lower over the last couple of years. It's come right down. And even before then, it's just gone to a poor spot. We can look at the next thing. I look at the financial summary because I talked about that too. It's I think it was number 6. And revenue, obviously had a huge revenue boost in the pandemic, but now it's kind of come off quite a lot. People probably cancelling, and earnings, they've been dismal. Operating margins really bad. Return on capital, there's no return on capital at all. It's completely eating capital. Cash flow, free cash flow, there's none, and no dividends. And average shares, it's been diluting a bit, not massively excessively as far as I can tell, but I wouldn't be. They've still got a lot of cash on the balance sheet, probably from whenever they listed and previous fundraisings. And so anyway, that's a very, very quick scan there. And then look at the analyst consensus here. It's still got a buy rating from 25 brokers, but the earnings are deteriorating. Now, of course, this could bounce. I mean, it's sold off so much, and I'm not saying that it won't. Like I said, but the odds are kind of 2-1 against if it's in that sucker stock classification. So I love the product. But I can't buy shares like this personally because I know the odds are stacked against me. So that's one. If I wanted to look at, I'm going to pull up a UK stock from more of a kind of dividend perspective. Hargreaves Lansdown, who I know well, and Hargreaves Lansdown are. Once again, let's look at the ranks. Well, it's a 62 rank. It's not terrible. It's not wonderful. Very, very high quality. 96 quality rank. 34 value rank. 45 momentum rank. So a bit sort of, not a bit below average on both of those. But the quality is obviously outstanding. Adventurous large cap. Neutral style. So it's not got a winning or a losing style. The market cap. This is interesting. The market cap is 4 billion, but the enterprise value is just a bit less. And that shows you that, it's got more cash than debt. So this has not got net debt, which I think is really telling. And scan the traffic lights, sort of medium kind of PE ratio against the market. It's certainly, it's not cheap, but it's not super expensive. Earnings growth, it's still got fairly moderate earnings growth. And, it's a bit more expensive on things like hard assets, but you'd expect that because this is a service firm. But look at those quality metrics. Return on capital, very high. And the professor flags, we don't actually do a bankruptcy risk for financials, but for a number of reasons. But there's no earnings manipulation risk, and the health trend is very strong. And it qualifies for a best dividend screen, which tells us this is an income stock. Let's look at the yield, 4.75%. Which is, certainly better than you can get in the bank at the moment, although interest rates are rising. And we can see not much action from directors. Institutions are kind of netting off in terms of what they're doing. Community is buying it as a whole. And again, I can look at revenue. It's growing. Net profits, pretty steady over the years. Nothing really, wouldn't call it a super growth stock, but it's had about a 9% revenue growth on average over the last 6 years. And then if I go down, this is where it gets interesting. Operating margins are getting squeezed a bit. More recently, and so is the return on capital. So you've got a kind of deteriorating return on capital, which I guess is a concern. There's a lot more competition out there for big brokerage platforms like this, and it may be that the likes of in the UK, some of the free trade, and in America you have your Robin Hoods, and but there is more competition. That might be squeezing margins, but they're also doing a lot of more investment. There's a lot of free cash flow though, and that, interesting, is much higher than earnings per share. And like I said, that shows that you've got kind of quite good dividend cover, 1.5 times and so on, but that's been getting a little bit less more recently. But as you can see, looking at this, is a kind of stock, and it's had a very, very flat number of shares in issue over a number of years. So that's just me kind of looking at a few forensically stocks very quickly that tell you quite a lot. So I thought maybe now, because I've done probably, just over an hour, so it's a kind of lightning tour of an hour, maybe I could sort of go to you guys and have a look at some questions. And there's some questions coming in. Well, that's one, actually. I actually did prepare a slide for this, but didn't know whether to show it. Where does the data come from? I'll jump back to my presentation if I can, because I think I've got a slide on that somewhere. And generally, if I just sort of show this, the data comes, the vast majority of our data comes from Refinitiv, and who are used to be called Thomson Reuters, and Refinitiv spun out and then got bought by London Stock Exchange. And Refinitiv are one of the kind of global big bellwethers here. You've got Bloomberg, you've got Refinitiv, and they're the kind of the biggest data suppliers to the industry. And we cut a deal with them before they really actually sold data to private investor facing firms. And they've got thousands of analysts who scan, audit, and standardize financial data into their databases before uploading to their cloud. And this process obviously starts with the auditors and accountants at companies, goes through Refinitiv into standardized financials, which we then start importing. We import from multiple different sources, including Smart Insider, FE Fund Info, and stock exchanges themselves. And we download all this information into our Amazon cloud servers, where we process financial statements, analyst estimates, price quotes, other company information, and then our analyst and developer team have organized this and clean it all up through scripts and processes. And our servers crunch something like 60 million computations daily to build up a library of more than 2,000 statistics on every stock. So that's where all of these algorithms and F-scores and Z-scores all come from. And then we rank and screen the market and then publish it all on the stock report. So this process, probably the next question is, how often do you update it? Well, it's updated every day. So quotes come in intraday, but actually our fundamentals come in through the day. But we have a compute process once a day in every region before the market opens. So generally, I can't remember what time it is now, but generally it's several hours before the market opens that the data is fresh and republished to the site. So that's kind of that on the data process. Well, that's a good question. How do you know if a stock is resilient to interest rates? Well, I think that's a good question, and really, let me just have a think about that one. I think it's been something that's kind of really important to have a think about. Like, I'm going to just focus on the UK for the moment, and I'm going to look at our ranks and ratings. So, one of the kind of key things that's happened in the last year, and if I take this from the top of the bear market, is we've seen that I'm just going to get rid of that for the time being. But in the dispersion of returns, like, all stocks in the market have been hurt. But one of the things that's most hurt is expensive stocks have been really, really, really re-rated downwards. So you can see here, this is the value rank. So this shows you the difference between cheap stocks and expensive stocks. And cheap stocks, they've fallen like 10%, but often they have dividends and things, which actually tends to kind of like give you, which means that the overall total return would have been better. But the really expensive stocks have been absolutely hammered. So if you had stocks which had a P ratio of kind of in the top quartile of the market, you are really talking about quite significant drawdown. And that's because in a rising interest rate environment, if you think about a discounted cash flow model, the discount rate is used to sort of create the end valuation. And as kind of rates go up, the end valuation comes down. And for growth stocks who have a lot of kind of long-term future value, that is a really, really key impact. So resilience to interest rates, firstly starts with valuation. And I think if rates continue to stay high, we may see continued multiple compression in expensive stocks. And I've been through a few market environments, and I saw this kind of thing happen before, after the kind of dot-com bubble. And, you saw that there was a regime of growth stocks which did really, really well all up until the dot-com bubble. And then after that, it kind of moved into the they were called old economy stocks back then. You had new economy and then an old economy. And then the value stocks did tremendously well right up until the kind of the financial crisis in 2009. And it was amazing, the difference. And that was a really significantly, there was a regime change. And those shares did very well. And so we saw after the financial crisis kind of very manipulated low interest rate environment, which meant growth stocks kind of went to the moon because, somebody even tweeted once, like in a zero interest rate world, the right P ratio for your growth stock is infinity. I mean, which is kind of the ludicrous thing that people say in those environments. So in talking about resilience to interest rates, of course, if you at some point the debt becomes a real problem, and or the interest cover is a key kind of important factor in which we actually have published here. So interest cover shows you how much the interest rates are covered, and it's important to sort of look at these kind of liquidity metrics and have a really good sort of sense of whether your stock has got that kind of distress risk baked in. But very interesting, I ran some studies, and I haven't put a chart together, but one of the studies I did is to look at actually the returns since the top of the bull market, and look at the difference in returns of indebted stocks. And I was amazed to find that the most indebted stocks actually had not reversed any more than the least indebted stocks. And I believe the real key reason why, and I looked at this in terms of the UK, the real key reason why is because of Brexit, pandemic, tough time for UK stocks generally. Those value stocks, the debted stocks tend to be value stocks, and they became so focused on being resilient through that period that they're much better placed to weather a storm. But I do think there are zombie companies out there which may well have trouble. People have talked about some on the site. I'm not going to name zombie companies, but really heavily debt burdened companies that could have a much higher, much bigger problem. But I would say look at the gearing ratios, look at the quality. We've got all the gearing ratios here, the interest cover, and make sure they've got kind of good liquidity and earnings to cover all of that, all of their debt payments. So hopefully that answers that question. Okay. Well, okay. I get this kind of quite a bit. A question has sort of come up about the US stock ranks, and I wanted to explain something in the light of something I said before. Why don't the ranks work in the USA? Okay, so for a long period, the ranks were not brilliant in the USA, but they weren't terrible. What happened is that the S&P 500, being market cap weighted, did exceptionally well. I want to share you something from the bottom of the pandemic. And, you can see here that since the bottom of the pandemic, and I'm just going to get rid of these. There's a story here, actually, that if you remember that kind of meme stock bubble that happened, and you had everyone sitting at home being given checks by the government, and all the most speculative stocks went to the moon. And of course, then they ended up reversing. So these kind of low-ranked, I call them sucker stocks, but this was the one period I've ever seen where they did exceptionally well. And people did make fortunes in them, but they don't last. And you can see the reversal in those kind of like shares has been absolutely brutal. And whereas at the other extreme, these are your kind of higher ranked shares. I'm going to get rid of some of these like lower ranked sets. And you can sort of start seeing that the high ranked shares ended up significantly outperforming. So the S&P, these 90, so since the pandemic bottom, if I can actually pick it out, you can actually see that 90 to 100 ranked shares have done 140% versus the S&P up 58%. And this is really reflective of this regime change in America, where the growth, because inflation, interest rates changing, now you're starting to see this reversal into value stocks which you didn't see before, and cheap stocks tending to dramatically outperform. And so from a value rank perspective, the really cheap value rank shares have done exceptionally well. So hopefully that answers your question. That's just kind of a myth. Okay, do we have lists of quality or value stocks according to your rankings? Yes, of course we do. And we have these in the browse section. So if you go into browse, well, they're on the homepage. Lots of good stuff on the homepage. You can find movers on there. You can jump to see the performance and so on. And also in the browse section, you'll see lots of popular screens, which includes our top ranked shares. So if I go and show you top stock ranked shares, and these are in a whole range of different market environments. So you can look at the US, UK, Australia, etc. And I can look at the whole world. Why not? And you can normally get a performance chart or performance charts across all the different regions. And it's a bit messy if I look at them all. I'm just going to focus on my home market, the UK. And you can see this is the top. We get a chart here. It shows how well they've done. That's a portfolio of 25. That's rebalanced regularly. And you get these lists. And these lists are fantastic. And you can click right through to the stock report. You get all these little summary views. All these tables are customizable. You can add them into a portfolio if you want. So I can put them in a portfolio and track them later. You can add them one by one or in many. So yes, we do, and you can you can go and you can customize these. You can create your own screens as you wish. So if I wanted to create a screen of, let's say, just the highest quality stocks, I can go add rule, search for quality, add the quality rank, and then I can search for quality greater than, let's say, 95. Why not? And here's 80 stocks. With a range of different market caps, and I could filter that down with the dividend, yield, and if I wanted to find high yielding shares, give me a yield higher than 5%, whittle it down. Okay, I've got 15 very high quality 5% plus yielding shares, and as a portfolio, you can see they're diversified across basic materials, energy, industrials. These are the sector classifications I was talking about. So a good spread, good yield portfolio with a high quality rank. As a dividend investor, what more really could one want? Not financial advice, as I said earlier, but I'm very passionate about this stuff. And okay, what are the and I should have some slides on the returns to quality, the actual quality, value, and momentum ranks themselves, which I could show you. So this is actually, I showed you the kind of overall QVM returns, and actually I'm writing a book about this at the moment, and some of these charts are in it. And so this is the performance of stocks, these are UK stocks, by the quality rank. So again, you can see that low quality stocks don't tend to do so well. High quality stocks over here, ranked higher, tend to do very well. Literally anything above a 50 quality rank is a much better part of the market to be in. But again, the highest quality stocks do tend to do well. Again, for value, same old story, and this is over almost a 10-year period. The 10-year anniversary is actually is upcoming, and as you can see, you get a really good return in cheaper stocks than you do in expensive stocks. And similarly, by momentum rank, highest momentum shares tend to outperform. And we found momentum is the most powerful factor, although because you often need to rotate into high momentum shares regularly, it has more transaction costs. But anyway, that's some of the results, just answering that question. I'm really conscious of time. I've been going for over an hour. I promised to do this for an hour. Okay, I'll take a couple of requests, just to quickly have a look at one. Okay, do we have an app? That is a good question. We do have an app, but it's a sorry, I'm umming a bit, but the app is available on a phone. You put it into your browser, so it's not in the iPhone, it's not in the iOS store or the Android store. Go to it in your browser, and then you'll get a prompt to add it to your home screen, which you can do. You can click it, and it will show you how to do that. And then you get it as a nice icon on the phone. I don't know if you can see that there, but I have that. And then I can load it up and I can view it on the go, which is really terrific to me. And so yes, you can actually use it on the go. And actually, I've got a little, there's a little slide here. It's a bit of a mock-up put together that shows you actually you can do it. It's all responsive, so you can use it on an iPad, use it on a phone, use it on a computer, and it's very very good. Okay, so I was going to do one or two requests. Fine. Let's. Well, yeah. Okay. Yeah. Well, actually, Yellow Cake is a mining. Sorry, that's a uranium stock, and yeah. So this one is a very high ranked share, and it's a super stock, adventurous super stock. It got no debt. You can see very quickly the rank has been very high, and it's been going up. Well, as soon as it jumped up through 90, it was at 246. It's gone up now, almost doubled. Very high quality. Qualifies for one of my favorite screens, the Magic Formula. 5 screens this qualifies for. That's good. Lots of director buying. Look at that. We can click through and see director buying. And what else can we see? That was actually a couple of different types of buys, not open market buys. I don't like. I prefer open market buys. And Health Trend is been okay-ish. We can look at it has been diluting. It's been issuing more shares, but as this is essentially, I do know Yellow Cake, as it is a uranium kind of store. I presume that this is they raise more capital to go and buy more uranium. So this is kind of a bet on uranium as far as I'm aware. Let's have a look at Ocado. Ocado in the UK is one of those stocks where we all get our groceries delivered by very regularly. If anyone does use them, they now I think M&S. But it's done really, really poorly. And it did have a huge rise, but then has done very poorly since the pandemic was over. Again, you've got a speculative large cap sucker stock. Tells me all I need to know. Stock rank of 12. Again, no profits, no financial ratios. It's got qualifies for no screens. 1 or 2 directors buying. I don't know why. But yeah, someone's put in... that's arousing. I wonder if that's to do with Tetra Pak. And but yeah, poor quality metrics. Professor scores, well, Health Trend's getting a bit worse. Profits are all negative. Margins are, there's no profitability there. When are they going to make kind of substantial profits? I presume one day, but it's a tough business. And average shares, well, not too bad, but it's been growing over time at a 4% dilution rate. And look at that, the consensus trend is down. It tells you all you need to know. I'm probably going to leave it there. I'll have a look at one because my brother loves this stock, Avacta. And I know, I'm certainly not going to make any judgment on this stock, and I'm just going to view it through the data. I know that this is a company developing some really outstanding technology, and for all kinds of cures to really large markets. And if they nail it, I'm sure they'll do extremely well. But obviously, this is a jam tomorrow stock, so it's a blue sky opportunity. So this kind of stock is always going to be ranked pretty poorly, and you can see the stock rank has been weak for all that period. Stock rank 17, highly speculative small cap momentum trap. You often find momentum traps. They have high momentum and very popular with private investors. And as you can see, the community are buying it more than they're selling it. And momentum traps tend to be sort of high, but they don't have the quality and they're very expensive. So it's just momentum going for it. And as you can see, and so this is amongst the 1% most expensive companies in the market, and the quality is in the lowest 20%. No kind of red flags, no earnings manipulation, got no earnings to manipulate, not going to go bankrupt because presumably it's got lots of cash on hand, and but not going bankrupt yet. It's got lots of, you look at the enterprise value, you can see they've got 10 million net cash, 12 million net cash, whatever it is. And so I'm not going to pass judgment on it. It's got, brokers aren't putting up their numbers. Usually these things are strong buys. It's going down, not as strong a buy as it was. It's only got one broker following it. Lots of people telling stories about it, and believe what you believe. And but hopefully they'll do amazing things for people's healthcare. Anyway, that's probably it. Just checking the questions. I don't want to take up all your time. Thank you so much for tuning in, and I'm going to leave it there. once again, do remember you can go and check all this out on the site. And just want to say thank you so much for tuning in. And I hope it was useful to you, and that you enjoy any replays to learn more about some of the things that I've discussed. And wishing you all the best. Take it easy.